Hey everyone, and welcome to This Explainer. Today, we're going to unpack Tata Power's Q1 FY27 results to try and solve what I think is a pretty fascinating stock market mystery. If you've been watching the energy sector lately, you already know the transition to green power is, well, it's basically the biggest structural theme of our decade. But every now and then, the market's short-term reaction to long-term fundamentals can really leave you scratching your head. And that is exactly what just happened with Tata Power.
Just look at this dynamic. It's kind of crazy. On the left, you've got a company reporting double-digit profit growth alongside a seriously aggressive clean energy pivot. And then on the right, look at the immediate market reaction. The stock drops over 1% right after earnings are announced, slipping down into the 372 rupee levels. So why? Why would a company executing flawlessly on its expansion strategy see its shares get sold off on a day of really strong?
So, here's our game plan for today. We'll start with the Q1 numbers, dive into the solar boom, check out the T&D turnaround, look at their EV charging leadership, map out the big 2030 green energy pivot, and wrap up with the analyst outlook.
All right, part one, the Q1 numbers. Because before we talk about big green energy targets, we really need to know if the core business is actually generating cash today. And it turns out Tata Power kicked off the year incredibly strong. We're looking at consolidated revenue growing 8% year over year to nearly 18,900 crore. Profit after tax jumped a very impressive 11%, hitting 1,401 crore. Their core operating earnings across the board, generation, transmission, renewables, they all grew by double digits. So they aren't just selling some distant future vision, they are delivering cold, hard, present-day profitability. But honestly, the most important number from this quarter wasn't actually the profit.
It was this. 5,375 crore. That is the amount of capital expenditure they deployed in this single quarter alone. It's an absolute record-breaking figure for them. The management isn't just sitting back on their hands. They're aggressively shoveling that cash flow right back into the ground to accelerate their clean energy dominance, their grid infrastructure, and their manufacturing capabilities.
So where exactly is that massive, record-breaking investment going? Well, let's talk about the solar boom, which is rapidly becoming a huge moat for the company.
Check out this staggering multiple, 3.9x. Their new 4.3 gigawatt solar cell and module manufacturing facility down in Tirunelveli, Tamil Nadu, delivered an absolute blowout quarter. The manufacturing profit literally multiplied nearly 4 times year over year to 381 crore rupees. I mean, this plant achieved over 95% manufacturing yields. This proves that Tata Power isn't just installing solar panels, they're successfully mastering the entire upstream supply chain, which completely secures their margins against global supply shocks.
And that momentum seamlessly carries over into the consumer space. Get this, Tata Power has been India's #1 rooftop solar company for 11 consecutive years. Just think about that kind of sustained dominance for a second. This quarter alone, they installed 371 megawatts of rooftop solar, which is up 37% year over year. They've now crossed a massive 5.2 gigawatts of total installed capacity, serving over 4.8 lakh customers across the country. They are literally turning everyday passive homeowners into active power producers.
Moving right along, let's look at the transmission and distribution, or T&D, turnaround, specifically in Odisha. Now, solar gets all the flashy headlines for sure, but we can't ignore the T&D network. It's the financial bedrock, accounting for 65% of their total turnover. Taking over state utilities is notoriously difficult, but Tata Power pulled off a massive operational turnaround in Odisha. They're actually the first private utility in India to serve over 1 crore registered consumers in a single state. The Odisha Discom saw profit rise 6% year over year this quarter, feeding into a broader segment that generated over 1,500 crore in EBITDA. They're actively lowering losses and turning these previously struggling grids into smart, profitable networks. Next up, we've got to examine their dominance in a vital new consumer frontier, EV charging leadership with the Easy Charge network.
Under the Easy Charge brand, they've rapidly built India's most expansive charging ecosystem. And the scale here is just wild. We're talking about more than 86,000 home chargers, over 5,900 public charging stations, and 1,200 e-bus charging points. They're active in 717 cities and towns right now. In the last financial year alone, this network logged over 414 million green miles, offsetting 50,000 tons of tailpipe emissions. To put that into perspective, they are essentially building the equivalent of the new age gas station network across the entire subcontinent.
All right, this brings us to the 2030 green energy pivot. This is where we zoom out from the short-term noise and look at the long-term strategic transformation.
This right here is the master plan. Today, out of their roughly 16.7 gigawatt capacity, about 47% comes from clean and green sources. But they are targeting a massive portfolio upgrade. By 2030, they want to nearly double their total capacity to 30 gigawatts. And the kicker? They want a staggering 70% of that overall capacity to come purely from clean sources. They already have a 12-gigawatt cumulative renewable portfolio, with 5.3 gigawatts currently under implementation. So this isn't just a slight pivot, it is a complete remaking of the company's DNA.
So given all these massive structural wins, let's explore analyst targets and the general outlook going forward.
Remember that initial 1% post-earnings dip we talked about at the very beginning? Well, the smart money, the brokerages, they are overwhelmingly viewing that recent correction as just temporary profit-taking. It's market noise. Despite the stock trading in the 370 to 390 range, major institutions are maintaining really strong buy ratings. JM Financial set a target of 485 rupees, and Motilal Oswal has a target of 490 rupees. They are completely looking past the quarterly blips and pricing in the massive intrinsic value being unlocked here.
The analysts over at Motilal Oswal specifically highlight a few major catalysts for this. First, they finally have commercial clarity at the 4,150 megawatt Mundra plant, which just secured a long-term supplementary power purchase agreement with Gujarat. Second, the massive visibility of that 12-gigawatt renewable pipeline we just talked about. When you combine legacy assets returning to full profitability with a hyper-growth green pipeline, it creates a very robust thesis for upside potential.
And it's not just the equity analysts who are bullish. The credit rating agencies are entirely on board too. Usually, if a company deploys record capex, like dropping 5,375 crore in a single quarter, leverage goes up and credit agencies start getting really nervous. But Tata Power has managed its balance sheet so incredibly well that S&P recently upgraded them to an investment-grade BBB rating with a stable outlook. Their net debt to EBITDA remains super comfortable at around 3.7 times. They're literally funding massive growth without jeopardizing their financial health whatsoever.
So as we wrap up this explainer, I'm going to leave you to ponder this earnings paradox. The stock market is famously a voting machine in the short term, but it's a weighing machine in the long term. Is a minor 1% post-earnings dip just a temporary symptom of a broader market mood? Or is it an opportunity to look at the immense 12-gigawatt green value being aggressively built right beneath the surface? When a company is quite literally rewiring a nation's energy grid, maybe it's worth zooming out. Thanks so much for joining me today, and keep your eyes on the fundamentals.